Hi, I'm Christine Benz from Morningstar.com. Investors often like the simplicity of investing with a single mutual fund shop. Joining me to discuss the pros and cons of doing so is Russ Kinnel. He's Director of Fund Research and Editor of Morningstar Fund Investor. Russ, thank you so much for being here.
Good to be here.
Let's discuss, for investors who are looking at this question, there are a couple of dimensions to it. Let's discuss the operational safeguards for people who are thinking about this and maybe worried about the risk of being with a single fund company. You say there are some protections in place, starting with custodianship. So let's talk about how that works.
That's right. Every fund has to have a third-party custodian that holds the securities, manages the transactions. So essentially, it's keeping it off limit, the holdings off limits from the fund company. So it would not be easy for a fund company employee to tap those funds. And in fact, I'm not aware of any case of that actually happening.
Now, fund company bankruptcies have been almost non-existent to my knowledge, but there have been a few instances where the parent company ran into financial trouble. Lehman Brothers was the parent company of Neuberger Berman. Let's discuss how that played out for fund shareholders in Neuberger Berman funds.
That's right. Because of the way the fund industry works, it's a pretty profitable business that's pretty stable. So bankruptcies are very rare. In this case, we had the parent of Neuberger went bankrupt, but Neuberger's investment personnel were able to buy the firm out from Lehman in a way that I think pretty quickly made investors feel good. So Neuberger kept on operating pretty smoothly despite the problems at the parent company. There were enough walls between them and Lehman, and really, if you're a Neuberger shareholder, you probably didn't even notice any impact. So you think about that's a fairly extreme case, and it still really didn't have any impact. So I think it really illustrates that there are a lot of safeguards in place, particularly with a sizable fund company.
You wrote about this issue in the December issue of Fund Investor, and the bigger issue to your mind, rather than some of these operational potential pitfalls, is the issue of having all of your assets with a firm with maybe a single house investment style. Let's talk about that problem.
That's right. I don't worry much about theft, but I do worry if you have all the inputs in all of your money that's being run being similar. So let's say you're at a firm and they're all buying biotech stocks, or they're all buying utility stocks or something like that. And so while you may have 8 or 10 different funds, maybe 7 of them are buying the same stuff. So that doesn't mean there's going to be theft. It means there's a potential for losses across the board, so that your diversification isn't as good as you thought it was. You can also look at it from another way. There could be an exodus of investment professionals if all of your funds are actively managed funds with the same firm and a lot of people are leaving. Again, that's not going to be a disaster overnight, but it could mean the quality of your investments slowly erodes.
I could see that you'd want to be concerned about the house style if it's a smaller firm, but what about the really large shops like Fidelity and T. Rowe Price, where you have a lot of different investment styles being practiced under a single roof?
Right. So the good part is you really can have tremendous diversification with T. Rowe or Fidelity because they cover the gamut: value to growth, foreign, domestic, all kinds of bond funds. So you can be tremendously diversified. I worry still a little bit about those issues where they may all say maybe all of the growth managers at a Fidelity or T. Rowe might favor similar stocks. So it's a less severe problem than the ones we've outlined, but it could still be a bit of a problem where you could still have a bunch of investment professionals leave. But yeah, T. Rowe, if you look at its history, the value funds stay in value, the growth funds stay in growth, so they're going to stay diversified. Fidelity, maybe not quite as style pure as T. Rowe, but still they've become much more specific in their investment style, and Fidelity's funds tend to have a lot of holdings, so it's unlikely you'd have a lot of exposure to, say, 3 big stock names or something. A lot of their funds have 100, 200 stocks. A lot of their bond funds are very sort of close to the vest in terms of being fairly close to the index and trying to add value through issue selection. So you could do a pretty good job. And then, of course, if you added, say, some index funds from either shop, that would also increase the safety level another notch, because those aren't going to be affected by an analyst recommending some names or investment professionals leaving.
Okay. Speaking of index funds, you mentioned in your article that Vanguard is the shop where you probably would have the easiest time thinking about putting all your money in a single firm. Let's talk about what attributes Vanguard has that makes it particularly appealing from the standpoint of perhaps being an investor's single fund shop.
Right. If I had to invest with just one fund company, it would definitely be Vanguard. Reason one is indexes. They've got indexes for a wide swath of asset classes, and index funds are going to be much less susceptible to any kind of firm view, any kind of firm problem. So that's the biggest reason. The second reason is on the active side, most of their funds have sub-advisors, some of them multiple sub-advisors, and that means, one, you're going to have lots of different inputs of alpha, different market biases, so that you're better diversified on that front. But also, let's say there's a problem at one manager at one Vanguard fund, they can fire that entire sub-advisor and move to another, so you don't really have to worry so much about an exodus, because Vanguard can fairly quickly act and take care of that. And then, of course, we know from Vanguard's overall firm structure, they're not going to be bought or sold. They're not going to be part of a disastrous merger. So there's some added protections there.
Okay, Russ, I know this is a question that you get a lot, whether it's okay to invest with a single fund company. Thank you so much for being here to shed some light on it.
You're welcome.
Thanks for watching. I'm Christine Benz for Morningstar.com.